Hi everyone. In this lesson, we're going to really get into the parts of the Schedule K that will really matter the most to you and how to treat them as you're building financial statements and entering this information into Halon. We're going to drill on Schedule K a bit here because it is very important. As I said in the 1120S lesson, Schedule K can be a bit tricky, and I want you to understand what it is. Now, rest assured, Halon's going to do all this work for you, and the CPA tax team reviews all of this. So it's not that you're actually going to be completing any Schedule Ks, but we want to make sure that you're doing the bookkeeping in a manner to where Halon can read it correctly and be efficient in the preparation of its tax return. And if clients ever ask you a question about it, I want you to have some idea of what these things are and why they're there. And doing a deep dive is gonna help us do that. Let me first start with a slide that I used in the last lesson when we were talking about the Schedule K and the 1120S forms. Let me go back to this slide and kind of refresh our memory about how the Schedule K works. So this is it. Remember, I've got kind of an income statement over on the left here that has sales and interest and dividends. And then as we understand, it breaks out into two different pieces. Just to kind of recap, in the 1120S, some of the items are reported on the Schedule K. Anything that is not reported on the Schedule K is reported on page 1 of the 1120S. These items that go into Schedule K are easy to understand once you have a good foundation of what they are and where they come from. In this video, I'm going to give you really everything that you need to know about the Schedule K and some of the most common Schedule K items. So just to recap here real quick, remember how interest and dividends, those go on the Schedule K, charity goes on the Schedule K, certain kinds of gains go on it. If it doesn't go on the Schedule K, that means it goes on the page 1 of the 1120S. So this is kind of our test of if it doesn't go here, then it always goes here. Make sense? Okay, let me show you a little bit more about the most common Schedule K items you're going to see, because those are the items we're going to do a really deep dive on for this video. So here is, in this next slide, is a zoomed in look at the top of the Schedule K, which, as you'll remember, is the third page of the 1120S. I've highlighted the lines that we're going to be diving into today. You can see that line 2 is net rental real estate, line 4 is interest income, then line 5 is dividends, 7 and 8 are your short-term and long-term capital gains, line 9 is the 1231 gain, and then 12A is the charitable contributions. I've selected these because this is what I see the most of. However, only about 25% of my clients have any of these. So 75% of my clients have none of this and are, really there's not much on the Schedule K at all other than line 1 and then some things down at the bottom that are distribution related. The rest of Schedule K is extremely rare. And I would say that at the end of the day, you're going to probably, in the $250,000 and under category, you're going to run into this only 1% of the time. When I say 25% of my clients have these, it's mostly because I have some clients that do $1 million, $2 million, $3 million worth of revenue, and those are the clients where I see some of this. My smaller clients, as I said, under $250,000, I almost never see any of this. But we need to know what's in here, right? We need to know if the client asks, if someone's curious, if we're reviewing a tax return with them and they have a question about it. We want to come from a position of knowledge, knowing good and well that if they do ask a question that we can't answer, you can always call Halon and the CPA tax team will answer that question. It's included as part of the service. So before we dive into, each one of these things, let me kind of show you how Halon handles them, because Halon has certain capabilities as it relates to each of these line items, and you need to know what requires a Halon upgrade and what does not. So Halon has two different, you can think of it as modes. Regular Halon means that the tax return is $149, and it can handle any type of tax return, 1120S tax return, s-corp tax return, under $250,000 worth of revenue or assets. However, there are certain issues that if they're in the tax return would require Halon to be upgraded to something called Halon Assisted. And what Halon Assisted is we have, this is because there's a CPA tax team, right? You know that. And if there's complexity in a tax return, we actually have those CPAs manually reviewing every page and possibly even preparing pages that the Halon software does not do very well. A great example would be dividends and capital gains, because those have to match a brokerage statement that you get in the mail. So the categories of Schedule K that require an upgrade are shown over on the left here in green. That don't require an upgrade, that don't require an upgrade are shown over here in green. That's interest income and charity. Halon can handle those just fine. But if you have rental operations, dividends, capital gains, or Section 1231 gains, we're going to want to upgrade that to Halon Assisted and have our CPAs review the work, make sure that everything is appropriately done, make sure that the schedules match, all of that. It's a higher level of assurance. And and I'm going to recap this again in another slide, but just to recap, under $400,000 worth of revenue is $350 if it's Halon Assisted. 400,000 in revenue to 600,000 in revenue is $499. And then over 600,000 in revenue is $750. It goes all the way up to $1 million. So those are the Halon Assisted prices. Regular Halon only goes up to $250,000. So if you have $1 million return, you're already going to be in Halon Assisted, right? So if you had all these other things going on, it'd be no big deal. It's still included as part of the Halon Assisted service. We're going to go through each of these 6 items. And we're going to dive into these in some detail. I'm going to go through the easy ones first. That is the interest income and the charity side. Those are easy. And then we're going to cover the 4 harder categories. So just to recap, no upgrade necessary for interest income or charity. An upgrade is necessary for rental, dividends, capital gains, or Section 1231 gains. Okay? All right, let's move on to the next slide here. So first we're going to cover interest income. And I realize many of you know what interest income is. It's the compensation banks give you for keeping your money deposited at the bank or purchasing bank or government bonds. What you may not know is that most interest is always taxed as ordinary income, just like the income from your S-corporation. So why do we have to break it out on the Schedule K? Mainly it has to do with something we call the nature of the income, meaning that your S-corp most of the time is active in nature. It's active income. You're working for it. Whereas interest is passive in nature, means you're not having to actively work for it. It's made through an investment. So while the way it's taxed may be similar, that is the S-corp income and your interest income, there are other parts of your personal tax return that are dependent on how much active income versus passive income you have. And that's why we have to break it out, is because they want to know what that active versus passive is on your 1040. So we're asked to break it out. Here's what Halon does. Halon looks through your whole financial statement and looks for anything called interest income in your financials and places that in the Schedule K for you. Halon also allows you to override these amounts and allocate Schedule K items. So if Halon doesn't pick up something and you notice it, because our accountants would notice it too in the review, but if you notice it, you can go into Halon and override something, and there's a certain section when we do the Halon training, we'll show you all about that. And you can override any of this too. So at the end of the day, Halon's looking for it. If Halon misses it, our CPA tax team will catch it. You might catch it and allocate it over there through a function in Halon. Either way, interest is easy. Just make sure that, and I kind of sound like a broken record on this, or I will by the end of all of your training. Just make sure you name things in a regular way. Name interest income, the words interest income. Don't name it something exotic that's supposed to mean interest income. That's where Halon can get a bit confused on what that's supposed to be. And then the second kind of easy one is charity. So When we're talking about charity, I need you for a moment to have your accountant hat on and not be too emotional about it. And what I mean is, when I give to charity, it's much more about the cause, right? It's much more about I'm giving money to this charity because I believe in what they're trying to do and I want to be helpful to that cause. The tax deduction is kind of a nice perk, right? It's not why we contribute to charity, though. It's a perk of contributing to charity. But when we're planning for our clients, we need them to understand the benefits and the drawbacks of charity. We need them to understand it. Doesn't mean it will change their behavior, but we are in charge of making sure that they understand some things about it. And this is really easy to have a meaningful conversation with clients about. See, to benefit from charity on your personal tax return, the taxpayer must itemize deductions, meaning that they have, taxes, in-state income taxes paid, or property taxes paid, mortgage interest, charity. They must have these other deductions that exceed, for the new tax law, $12,000 for singles or $24,000 for married folks. If they don't itemize their deductions and they take the standard deduction, then whenever they contribute to charity, they're not really getting any tax benefit from that because it's not enough to eclipse the amount of the standard deduction on their personal tax returns. The reason I mention this is if they don't own a home or have, mortgage interest of some kind, then it's going to be very hard for this to be worth too much unless they're giving tens of thousands of dollars to charity. So many times people, will be giving to charity and they're asking me, so aren't I what did I save by doing that? And I'm having to say something like, well, you didn't save anything because it's not enough to eclipse the standard deduction. So here's a strategy that you can kind of mention to them. If they don't contribute enough to charity each year, what they can do is they can contribute a large amount in year one, then wait 3 years and contribute another large amount in year 4. It's what we call grouping. And the way that works, you're essentially giving over the course of those 3 or 4 years, you're giving the same amount to the charity, but you're doing it all at once in 1 year rather than breaking it up over multiple years and not getting any benefit on your tax return from it. So that's a strategy to mention to them and make sure that they're doing. Either way, as it relates back to Halon, try to have them keep charity out of the business if you can. It's just making more work. And when we put it on the Schedule K, it goes in the exact same place on their personal return that it would have had they done it personally. And here's what happens. Business owners just like to do things through their business. It's because they don't understand the value in the business versus doing it on their personal. They're used to, in some cases, especially if they take the standard deduction, not itemized, they think if they do it through the business, they're getting a deduction for it, but if they did it personally, they're not. You need to let them know that whether they do it through the business or through the personal, it all goes in the same place. And if they don't itemize deductions, they get no benefit regardless of whether they do it through the business or just through them personally. So that's really the message here is don't run it through the business. Do it on your personal because there's no reason to complicate things. Halon scans for anything with the word charity in it and places those transactions here. So don't name anything charity, right? That's not supposed to be charity. If you've got an employee named Charity that you're paying some kind of amount to, not through payroll or something, don't name it that in the financials, right? Because Halon's gonna pick that up as a charitable contribution. Name it something else. Leave the words charity only for charitable contributions, right? I told you I'd sound like a broken record, but I'm gonna get this point across. The naming conventions in your financials matter to Halon, and we want to name things very obvious names, okay? All right, let's move on. So now we're going to get into the transactions that will require Halon to be upgraded to the assisted level. These require manual reviews and form prep by the CPA tax team, and so they cost more. As I mentioned before, Halon Assisted is $350 up to $400,000 of revenue, $499 up to $600,000 of revenue, and $750 between $600,000 of revenue and $1 million. Okay, so those are the price points. Plan accordingly. For rentals, if you have a rental situation in an S-corp, you get one property included in your Halon assisted fee. So if they just have one rental property, your Halon assisted fee is good. If they have more than one, for each property after one, you're charged an additional $100. So if you had 6 rental properties, you would need to pay an additional $500 on top of the Halon assisted fee, because you'd get one for free and the other 5 are $100 each. So, obviously, if you have an S corporation with a ton of rental operations in it, this can get a little bit spendy, right? But there's nothing we can do about it. You need to be mindful and factor that in your quotes. If you've got an S corporation that has 6 rental properties, trust me, you should be charging them hundreds of dollars more to do that work. And you'll see in the way that we price rental operations on my standard pricing sheet, we're trying to account for that, right? We charge them something like $13 a month for it. So you're charging them $150, right? A little bit more than that, for their rental properties, and you're having to send that over to Halon for $100 of that. So maybe charging them $20 per rental property isn't a crazy idea, right? Because you still got to do the bookkeeping on it. Anyways, make sure you factor all of that as you're pricing things. The income from rentals is passive, which means many high earning taxpayers, if they're running losses in their rental operations, don't actually get the benefit of those losses. It phases out at around 150,000. It starts to phase out, I think, at 100,000 and completely phases out around 150,000 of income. So if they're making like 300 grand and they're running losses in their rentals, they're actually not getting any benefit from that. That is being saved for when they sell the property, then they can take it. There's lots of rules surrounding rentals. You don't need to concern yourself too much with it. Just know that for people who are making large amounts of money, 6 figures or more, their losses can get limited. If they make money, if they have income, well, that's just taxed. So that's not a big deal. But if their depreciation and all their expenses are exceeding what they're renting the place out for, that's where the losses can get limited or pushed forward to future years. Another part of rentals is they must depreciate the buildings, but only the part that is not land. So when you're capitalizing buildings for a client, make sure you have some basis of what is land and what is building. Appraisals are really the only way to do that, but in the absence of an appraisal, just have the client make a judgment as to what the building chunk is and what the land chunk is. I usually like to say that it's probably like an 80-20 situation where the building might be 80% and the land might be 20%. Just make it reasonable and it will probably hold. Halon looks for the fixed assets. It also looks for the land. So as long as you are naming things correctly on the balance sheet, it's going to look for those things, find them, capitalize them on the tax return, and do the depreciation for them. And the key here is just make sure that you're naming them, building or something that sounds like building, structure, those kind of things. We have several names that Halon is looking for there. And then if something is called land, call it land. If you have multiple buildings, you can call it the 9523 Main Street land. If it just sees land anywhere in there, it's going to believe that it's land. Does that make sense? And then you can have the 9583 Main Street building or structure. Keep it simple, but just make sure you break it out in the financials, and Halon's going to go in there and do all of this for you. You're going to have CPAs reviewing it, of course, because this is part of Halon Assisted, so you can rest pretty easy that there's quite a bit of oversight going into that. I've put the form for rentals, the 8825, on the right of this slide. It's simple. You can do 4 properties per page, and the 8825 actually has 2 pages, so really you can do 8 properties on one form 8825. You can have as many 8825s as you like. So the way this works is address goes on the top, where you can kind of see A, B, C, D up here. This is where the addresses go. And then these 4 columns is kind of like an income statement where you're showing the gross rents and then all the expenses. And what happens is then all the properties get added together to show the total income or loss, and that's what goes on the Schedule K. So these forms, all these 8825s, let's say you had 5 of them that had 8 properties each, you had 40 properties, they would all get summed together, And then one line item goes on the Schedule K as rental income or loss. Sometimes clients have multiple properties, but then we'll also have a management company doing the oversight. I wouldn't recommend that the same S corporation have the management company operation and the properties inside of it. I actually wouldn't recommend that properties are held inside an S corporation at all. I told you that in some of the first videos that we ever shot. But if you do have it, the management company actually, the income and the expenses from the management company can go on the page 1 of the 1120S, whereas the rental operations go on the 8825. However, try not to have the management company be the same company that owns the properties, because that's going to get very convoluted. We can handle it. The accountants and the CPAs in a assisted Halon situation will do it right. I'm just saying it's going to create confusion and kind of a pain in the rear on your end and on the client's end, because there's lots of allocating you have to do. So the best thing to do is have the management company be one entity, which would file its own S-corp tax return, and that would all go on page 1, of course. And then the properties, typically we like to see those owned through a partnership. And if you really needed it to go through an S corporation, you could have all the properties in their own LLCs, and then all of it flow to an S corporation. But again, I would usually put that in a partnership, just so you're a little more flexible with the ownership rules and who can own it and how many shareholders, that kind of thing, if you got into huge amounts of properties. If you have any questions on if something will be upgraded or how Halon will handle something like a rental situation, just reach out to Halon support once you know you have a question, and we will take a look at what you're putting together. We'll take a look at the books. We'll usually ask you to sync the bookkeeping to Halon, and we will go through it and help you kind of get ready for how to do that, even help you quote it if you need help quoting that. So if you have these kind of situations, just let us know and we'll help you navigate those waters. All right, let's jump over to section 1231, gains. So we have an entire module on gains and losses coming up, so I'm not going to get too much into it here. Just know that if property is depreciated, many times the gain or loss on such a transaction, if it's sold, involves a 1231 type gain loss. And we have to break this out differently. The 1231 gain is treated differently on the personal return when the taxes are calculated. So we have to put the 1231, and basically it's capital gain. So we have to break these things out differently than ordinary gain, which is kind of contrived from depreciation. The ordinary gain actually goes on page 1 of the 1120S, because the tax treatment is not different than your ordinary income on your 1120S. It's just like regular income. And that ordinary gain, what it is doing is it's recapturing depreciation, which is an ordinary expense whenever it's taken in previous years. So that kind of makes sense. Let me show you in this slide what's going on here. You can kind of see that if we sold something for $25,000 that had a cost basis originally when we bought it for 15 grand, even if we wouldn't have depreciated it, we would have a $10,000 gain, right? Because we sold it for more than we bought it for. That's where this 1231 gain is, right here. And then because we depreciated it in prior years, we have to pick up that gain too, because the adjusted basis is 13,000. We have to pick up this gain because we depreciated it and sold it for more money than we bought it for. And that is ordinary gain, because we were able to take an ordinary loss when we depreciated it. I hope that makes sense. It's just basically recapturing what we were originally able to expense. Now, before you go, oh my goodness, this is getting more complicated now. Let me ask you this. How often do you see your clients buy a piece of tangible property, not real estate or a building or something? I'm talking about like a desk or a chair or something like that, and they use it for a while, meaning they depreciate it. Then they sell the desk for more than they paid for it. How often does that happen? Right? Not very often, right? This is something you will hardly ever see unless there's some kind of special case. The IRS says that only about 8% of S corporations have this, and of those, mostly are very large corporations that are selling property that isn't like a desk. It's selling machinery or something like that, and it turns out it was worth more after they used it than before, that kind of stuff. So do not think you will see this very often. More than likely, you're going to see them depreciate something and sell it for zero or throw it away. And in that case, you're not going to have these breakout of gains, and you might have losses, but the losses are a lot easier to calculate, right? It's just whatever you sold it for versus what was still left in its basis, that's the loss. So don't think that you're going to see a lot of this. I just wanted to explain what it is so that you knew what it is, right? And that's what it is. 1231 is the gain that's kind of the capital gain, as I said before, between what you bought it for and what you end up selling it for. And then if you took depreciation on it, the recapture of that depreciation as you're selling it, that's the ordinary gain. And this goes on the 1120S page 1, the ordinary gain was, whereas section 1231 gain goes on the Schedule K and then gets broken out to the K1s. Make sense? Okay. Let's chat about dividends and capital gains. And I combine dividends and capital gains because they're kind of related to each other, right? They come on these brokerage statements. It's the last piece here. These are not really complicated, but the problem is that the tax return has to tie out, meaning match, to these brokerage statements that I have on the slide. And that means we have to wait for these brokerage statements to be mailed to our client, then the client has to give them to us, and then when we do the tax return, we have to make sure that these amounts match what's on these statements. If they do not match, we get a nasty gram from the IRS. The client calls us and says, hey, what's going on and more, right? So these are kind of a pain. I never see these. I'm here to tell you, I never really see this stuff in an S corporation. Very few people do trading of stocks and things like that inside their S corporation. But if you have it, we can handle it. The IRS says that about 6% of S corps have this in one way or another. One of the drawbacks to this is these are notorious for being sent out late, like not until March or even April. And that means that in most cases, if you've got an S corporation that has this in it, we're going to extend it and then do it after the extension deadline, because S corporations have to be extended by March 15th. So more than likely you're looking at an extension. Then you're going to send in these statements along with the Halon information. The CPA tax team is going to prepare all of this. We're going to make sure it matches, and everything's going to be great. But it's just, it's going to slow you down a little bit. Oh, once the tax team has them, they match everything up. If there's changes that need to be made to the books, we're going to update you on that. Let's say you booked dividends for, in this example here, the form says 17,700, but your bookkeeping only showed 17,300. We're going to go back to you and say, hey, let's update QBO to 17,700 because that's what ties out to the brokerage statement. If you're unsure what a dividend is here, let me back up real quick. It's the money that public companies declare that they're going to send to shareholders each year. It's the portion of the profit that they don't plan to reinvest in operations. And the reason we have to break it out on the Schedule K is because on the personal tax return, dividends are taxed differently. There's different dividend tax rates based on how long you owned the dividend or the underlying stock. Like, see how it says this qualified dividends right here? That means that you own the stock for a certain length of time. I think it's 5 years. And so you get a special rate on top of the special dividend rate. So there's lots of personal tax return stuff that goes on with this. All we have to show on our S-corp tax return is what this form is showing. What's ordinary dividends, what's qualified dividends, and then what's the capital gains and losses. Capital gains and losses occur when you sell stock that you've owned. It can be short-term, meaning that you own the stock less than a year, or it can be long-term, meaning you owned it for more than a year. If you sell the stock for more than you purchased it, you have a gain, right? And if not, you have a loss. Again, short-term capital gains and losses, long-term capital gains and losses, all treated differently on the personal tax return. Thus, we have to break it down in Schedule K. You're getting the theme, right? When the personal tax return treats income in a weird way, all of a sudden the Schedule K exists because we've got to break that all out and so that we're not lumping it all into the 1120S income. That is the purpose of the Schedule K. Again, you're not going to see a lot of this. And if you do, the CPA tax team is going to be in close communication with you, making sure everything gets done correctly. So don't stress over it. Just know that if you have an entity with some of this stuff, you're going to get upgraded to Halon Assisted, and then in this case, you're probably going to get an extension so that we can wait for the statements and everything to come in the mail. All right, that's really most everything I wanted to talk about. Let me jump to the action plan real quick. An action plan is really simple, right? It's interest and charity don't require an upgrade. Dividends, capital gains, 1231 rentals do need an upgrade. And then I'm going to show you in another video when we're training on Halon how to use the Halon data entry to make adjustments if Halon doesn't pick up the naming conventions in your financials correctly. And part of us training you when it comes to the Halon system, we're going to train you in that module how to recognize if some of this stuff hasn't been picked up, and then how to use the data entry piece of it. It's really easy, and it's really simple to do. It'll take you like 2 seconds to check and just make sure some of these things were picked up the right way. And if not, if it still slips through even your eyes, the CPA tax team picks it up. So, you know, that's why the Halon system works, right? Is because you guys are looking at things, the CPA tax team's looking at things, Halon's looking at things. That means nothing gets missed and everything is very, very accurate. So that's the action plan for this Schedule K module. And then that's it. So 31 minutes, not too bad. We're done talking about the Schedule K though. I think we've probably driven it into the ground, right? But if you do have any questions, reach out to us. We'll be happy to answer those. Thank you for watching. I've got some more left in this Accounting 1 module, so let's keep going. I will see you in the next video.